just told a client to walk away from a deal in Richmond's hottest submarket. Perfect property, great bases, institutional quality bones, but the numbers hiding beneath the surface told a different story. Meanwhile, three submarkets that most investors are ignoring right now, that's where institutional money is quietly stacking positions. Here's what separates the winners from the bag holders in 2025. Knowing which 8.2% vacancy rate actually matters and which one is a statistical mirage. Most buyers are looking at the wrong data. Three areas I'm about to show you have something in common that overrides every traditional metric, and if you don't know what it is, you're about to compete for all the wrong assets. Richmond's multifamily market sits at 8.2% vacancy as of September 2025. This is above the 10-year average of 6.8%, and it's trending higher. Here's what most investors get wrong. They see one vacancy number and think it applies everywhere. Richmond has over 5,400 units under construction right now. That's 5.1% of existing inventory. National average, 2.6. So we're building twice as fast as the rest of the country, and not all of that supply is hitting in the same areas. Vacancy ranges from 1.7% in Sussex County to over 19% in the West End. That's not market softness, that's systematic supply-demand imbalance in specific submarkets. Most of the new construction is concentrated in two places: Western Henrico County with 1,800 units, and downtown Richmond, over 2,000 units coming online. These are the areas where institutional buyers are getting cautious, and rightfully so. Let me show you three charts that separate the buyers who win from the ones who overpay. Chart 1, vacancy by submarket. Look at this spread. Prince George sits at 4.8% vacancy, Sussex at 1.7%, Eastern Henrico 9.1%. But when you see the West End at 19.3%, more than double the metro average, this isn't random, it's systemic oversupply in specific areas. Chart 2, pipeline concentration. Now look where supply is concentrating. Western Henrico County has 1,824 units under construction, downtown over 2,000 units coming online. These are the areas where institutional buyers are getting cautious. Meanwhile, Chesterfield County has 0 units under construction. Prince George County has 0 units under construction. That supply discipline creates operating environments where rent growth can stick. In chart 3, rent growth versus vacancy. Here's the relationship that matters. As vacancy climbed to 8.2% in metro-wide, rent growth slowed to just 0.8% over the past year. But submarkets with vacancy below 6% are still seeing rent growth above 5%. Location determines performance more than asset quality in this environment. Submarket number 1, Chesterfield County. Chesterfield County has 14,000 units, vacancy at 8% below the market average. The submarket absorbed 1,100 units over the past year. That's the highest absorption in Richmond. Average rent is $1,645 with 2.1% growth. What makes Chesterfield work? Employment diversity, infrastructure, and household formation dynamics. For institutional buyers, it offers scale with stability. Properties average 201 units. There's 0 new construction in the pipeline. That means no new competing supply hitting the market for at least 18 months. Submarket number 2, Eastern Henrico County. This county has over 4,000 units with 8.8% vacancy. Only 16 units of net absorption over the past year, but that reflects minimum new supply, not weak demand. Average rent is $1,372, $200 below metro averages. The rent gap represents over $2,400 annual per unit potential upside. And for value-add buyers willing to execute renovations on 80s and 90s construction, Eastern Henrico offers replacement cost discounts with established location fundamentals. You're buying a basis that cannot be replicated by new construction, and when supply constraints tighten across the metro, this submarket will benefit from spillover demand. Submarket 3, Prince George County. Prince George County has over 590 total units, but 4.9% vacancy and $1,700 average rent, above the average metro. Most impressive, 13.3% rent growth, the highest in Richmond. Why is the small southern submarket outperforming? Supply constraints and demand concentration. Limited developable land means supply can't flood the market. 0 units under construction, 0 delivered in the past year. When you combine stable demand with constrained supply, rent growth becomes inevitable. The trade-off is liquidity, smaller buyer pools and longer hold periods, but for patient capital, Prince George offers the best fundamentals in Richmond. West End submarket, avoid entirely. Vacancy spiked to 19.2% with 92 units absorbed versus 316 units delivered. That's nearly 4 units of new supply for every unit of demand, and developers are still building. That's a value trap. Buyers who chase low prices here will spend the next 3 years fighting occupancy problems while new supply keeps hitting the market. Midlothian submarket, despite 8,400 units of scale, vacancy jumped to 9.2%. They delivered 581 units and absorbed 918 over the past year. That looks okay till you see there are 402 more units in the pipeline. No margin for error if demand softens, and with Richmond's broader supply pressure, demand will soften. These are value traps institutional buyers won't touch. Richmond's fundamentals support selective investment. Population growth of 4.9% over 5 years versus 3.1% nationally. Employment up 6.5% over the pandemic levels versus 4.8% nationally. Recent expansions include CoStar Group adding 1,000 positions downtown and San Mar creating 1,000 logistics jobs. Richmond benefits from government employment, Federal Reserve presence, and growing port activity. But the construction pipeline has 5,473 units under construction, 5.1% of inventory versus 2.6% nationally. These units deliver over the next 18 months, creating a continued supply pressure. This environment favors selective submarket strategies over broad exposure. You cannot buy Richmond as a whole and expect to win. You have to pick the right submarkets. Here's how to allocate capital today. Core investments, 60% allocation to Chesterfield County. Target stabilized assets built after 2000, with units above 900 square feet, accept current yields for defensive characteristics. These are assets that will weather supply pressure and maintain occupancy. Opportunistic investments, 25% allocation in Eastern Henrico County, focus on 80s and 90s vintage, needing capital improvement. Buy below replacement cost, execute value add strategies. This is where you create alpha through operation improvements and rent growth. Satellite investment, 15% allocation to Prince George County, except lower liquidity for superior growth fundamentals. Target smaller properties where hands-on management drives performance. This is your growth allocation, high risk, high reward. Everywhere else, only at distressed pricing. Risk management becomes crucial. Maintain higher cash reserves, focus on shorter-term financing, and avoid properties requiring major capital expenditures in year one. Vacancy is forecast to rise moderately through late 2026 before stabilizing. Rent growth expected in the 1% to 2% range, rather than double-digit growth of 2021-2022. The buyer window for buying quality assets at reasonable prices won't stay open forever, but it's open right now for investors who understand submarket dynamics. Richmond remains attractive due to population growth, employment diversity, and business-friendly policies, but success requires precision in submarket selection. The days of buying anywhere in Richmond and making money are over. Now you need to know where institutional capital is deploying and where it's staying out. Richmond Multifamily offers opportunities, but they're increasingly concentrated in specific submarkets with specific characteristics. If you want submarket level strategy for your next acquisition, call with me. My phone number is in the description. I'll show you exactly where capital is deploying and where it's staying out. We'll review transaction comps, analyze rent roll performance, and build underwriting models that account for Richmond supply and demand dynamics. The opportunities do exist, but only for investors to know where to look. Don't chase yesterday's pricing. Don't wait for supply pressure to resolve. Build your strategy around today's buyer math and tomorrow's fundamentals. The smartest capital is already repositioning. The question is whether you're ahead of the curve or behind it.